Hello everyone, welcome back to my channel. In this video, we will discuss the third chapter of 10th grade CBSE curriculum, Money and Credit. We are going to continue our discussion on credit and talk about some very important things. What are the terms of credit? What are cooperative societies and how do they help with loans? Types of credit sources. Let's begin. What are the terms of credit? Let's say you take a loan. Is it just about borrowing and returning the same amount? No. Every loan comes with conditions, and these are called the terms of credit. These include interest rate. This is the extra amount the borrower has to pay in addition to the loan. For example, if you borrow 10,000 at 10% interest, you'll have to repay 11,000. Now, second is collateral. This is something valuable that the borrower owns, like land, a house, a vehicle, gold, livestock, or even bank deposits. It acts as a security for the lender. If the borrower fails to repay, the lender can sell the collateral to recover the money. Now, third is documentation. Proper paperwork and records are required, like identity proof, income proof, land records, etc. Fourth would be mode of repayment. This means how and when the borrower has to pay back, in monthly installments, lump sum, or after the harvest, etc. So all of this together, interest, collateral, documentation, mode of repayment plan, make up the terms of credit. And here's the interesting part. These terms vary from one situation to another. They depend on who is the borrower, who is the lender, what the loan is for, and how risky the situation is. In rural areas, people don't just borrow from banks or money lenders. They also borrow from cooperative societies, also known as cooperatives. But what is a cooperative? A cooperative is a group of people who work together and help each other financially. Let's take an example of one such society. Krishak Cooperative. It is located in a village near Sonpur. It has 2,300 farmer members. The members put in their money as deposits. The cooperative then uses that deposit as a collateral to get a big loan from the bank. With this fund, it gives loans to its members for buying agricultural tools, cultivation like seeds, fertilizers, fishery and farming activities, house construction, small business needs, etc. Once members repay the loan, the money can be given to the other members and the cycle continues. These loans often have lower interest rates than private money lenders, less pressure for repayment, more trust and flexibility. So let's look at the key point and explanation for it. Terms of credit, basically conditions of a loan, interest, collateral, documentation and repayment together becomes the terms of credit. Collateral, basically assets given as security for a loan. Interest rate, extra amount paid on top of a loan. Documentation, papers needed to process the loan. Cooperative societies, groups that help their members get loans often on better terms. Example, Krishak Cooperative helps farmers by pooling money and giving loans. Now let's try and understand where people get loans from, who controls them, and why it matters to the economy. What is credit? Let's quickly revise. Credit or a loan is an agreement in which the lender gives money or goods to the borrower with a promise of payment later, usually with interest. Now moving on to types of credit sources. All sources of credit can be divided into two main groups, formal sector and informal sector. Under formal sector, you take loans from banks and cooperative societies. Under informal sector, you can take loans from money lenders, traders, employers, relatives, friends. Formal sector includes banks and cooperative societies. These are regulated by the Reserve Bank of India. RBI makes sure that banks maintain a minimum cash balance, that is 5%. Loans are given to all kinds of borrowers, not just businesses, but also small farmers and poor people. Banks submit reports about how much they lend to whom and at what interest rate to RBI. This ensures transparency, fair practices, and lower interest rates. Now moving on to informal sector. This includes money lenders, shopkeepers, employers, friends, and relatives. There are no regulation. They can charge very high interest rates, use unfair methods to recover loans, take advantage of poor borrowers. The cost of borrowing from informal sources is much higher. Now, in rural areas, a large portion of loans still comes from informal lenders. This is a problem because high interest means borrowers have less income left. It can lead to a debt trap where people keep taking loans just to repay old ones. In the case of Sapna the farmer. Now let's look at this graph to understand the loan situation in urban households. 54% of the poor household have taken loan from informal sector. 38% of the household with a few assets have taken loan from the informal sector. 27 of well-off households have taken loan from informal sector, and only 17% from rich household have taken loan from the informal sector. So it's very obvious that the poor people are 54% and rich are only 17%. So poor people are more dependent on informal credit while rich people mostly use formal credit. Now what are the problems? Only half of the credit needs of rural people are met by formal sources. Poor people end up paying more because they don't have access to banks and sometimes also lack knowledge about it. Rich people get loans easily and cheaply, but the poor struggle. So what can be done? Banks and cooperatives need to lend more in rural areas, make credit easily available to the poor, reduce dependency on money lenders, ensure fair interest rates and equal access for everyone, create more awareness about formal sector loans and the process to get it. When people have access and knowledge about cheap and fair credit, they can grow more crops, start businesses, improve their incomes, and develop the economy. Let's take a quick recap. Terms and their meanings. Formal credit, they are loans from banks and cooperatives regulated by RBI. Informal credit, loans from unregulated sources like money lenders. RBI's role supervises banks, ensures fair practices. Problem, poor people rely more on expensive informal loans. Solution, expand access to formal loans and knowledge about it, especially for the poor. That's all for today. You'll find the notes now. If you found it useful, give this video a thumbs up, hit subscribe, and don't forget to comment your thoughts below. See you soon. Until then, stay smart and stay curious. Thank you.